walk you through a real life experience how I evaluate property management companies so you can be prepared. Whether I'm looking to buy or sell one or help someone understand what their company is truly worth. Because here's the truth. Most PMC owners, when you go to sell, you don't actually know what your business is worth. You know how many doors you manage. You know how much revenue you bring in. You know how hard you work. But when it comes time to sell, you either widely overprice it or you leave serious money on the table, which I have experience seeing. And both of these are very expensive mistakes. So today, I'm going to walk you through the 4 methods I use to evaluate a PMC. So when you're ready, you know how someone's going to evaluate. No theory, no textbook fluff, real methods using real acquisitions. And I want you to come along with me as I evaluate one property management company that's on my desk today. I'll leave space throughout so you can plug in your own company numbers to understand what your company's worth. The 4 methods we're going to cover are price per door, which is an older method not seen as much today, EBITDA method, multiple of revenue method, and cash on cash method. By the end of this, you'll know how buyers are going to look and evaluate your company. That way you're ready and have all the knowledge to be able to sell for a higher price. Let's get into it. Okay, imagine this. A property management owner reached out to me. They say, hey, I'm thinking about selling. Not fully committed, not desperate, just exploring. You've heard those phrases before. Usually that means one of 3 things. They're burned out, they've hit a ceiling, or they've realized someone else may value the business more than they do. Sometimes it's retirement, sometimes it's frustration, sometimes they're just tired of owner calls at 9 p.m. Whatever the reason, the conversation starts the same way. What do you think your company's worth? And that's where the real work begins, because emotion and value are 2 different things. And just because you spent 15 years with blood, sweat, and tears building your baby, it doesn't mean the market pays for that emotion. Buyers pay for systems. They pay for cash flow. They pay for predictability. So let's evaluate this company that I have on my desk today. Here's the example. Total amount of doors managed. They manage 980 doors, okay? Let's go there. The annual revenue for this company is $1,243,600, okay? That's their annual EBITDA. This is where it actually got a little sad, which there's a lot of companies like this right now, is let's say 25,000, okay? Right here I have monthly churn. We calculate on monthly churn, but I know most companies out there calculate on annual. So I'm gonna tell you their annual churn is 25%. Guys, if you can, start getting that number down, okay? Staff retained after sale, 100%. I'm always going to, and most people want to keep the staff on. Geographic concentration strong. Are you concentrated in one little area or are you spread out? Okay, this company is very concentrated within 10 minutes of the office. Incredible. Owner dependency, is it high or low? Yes or no? So this owner, he works over 40 hours a week in this business. That is high concentration. That means he is a big operator. Okay? The fact of the matter, valuation isn't just math. Risk changes the multiple. A company with clean systems and strong retention gets paid more. Okay? That's not strong retention. Okay? A company held together by an exhausted owner gets discounted. Now let's run the numbers, okay? We're going to get off this. We're going to go up. Let's go to method 1 that I explained. The method 1 is PPD, price per door. This isn't seen as much in the market anymore. This is the easiest method. Hey, this many doors, this is what it is. It's probably the most common about a year ago. I've seen something different in the industry now. And honestly, and the one people talk about the most, how much per door it sells for. That's the question, okay? Because the PMC doors are inventory. You're buying contracts. The more quality the doors you have, the more valuable the business becomes. But not all doors are created equal. Single family doors, luxury homes, HOA heavy portfolios, scattered various concentration, huge differences. Still, price per door gives us a fast starting point. Okay, so let's go through the formula. Okay, how many doors? What did I say? 980. Okay, market price per door in this area for this P&L that I saw was around 850. Okay, that's the price per door. Okay, so what do? We go 980 times the 850, and what is that gonna get me? That's gonna get me $833,000. Okay, now, how do you find the right price per door? This depends on your market, and some PMCs trade at 500. I've seen it and I've done it. Others 1,500. I've seen all the way up to 5,000 because it was really run very well. So this is a fast way to start, but you still have to look at other things. You still have to look at the P&L, especially if they're premium portfolios. In a strong acquisition market, it moves fast. In a weak market, buyers get conservative. So if your company has low churn, great owner retention, high rents, strong maintenance margins, and low owner dependency, your per door number goes up. If it's messy, it goes down. This is why two companies with the same number of doors can sell for completely different prices. Don't be the one on a bottom price. Doors alone don't tell you the full story, but it's a strong first filter. So I'm gonna pause the video and I want you to run your numbers, and then we're gonna come back and I'm gonna show you another method. This way, we're working through it together. Okay, now that you've ran your numbers, now we're back. Now we're gonna go over method 2. This is where sophisticated buyers live, EBITDA method. I love this method because revenue is nice, but profit is what matters. No buyer wants to buy your stress. They want to buy your cash flow. That's where EBITDA comes in. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In simple terms, how much real operating profit does this business produce? That's what buyers want because they're buying future cash flow, not just your door count. Door count doesn't mean anything. The formula, let's go through the formula. It's EBITDA times a multiple equals the estimated value. Most PMCs trade somewhere around 3 to 7 times EBITDA. Sometimes higher, sometimes lower, depending on the risk. Let's calculate it though. This is where we get good, all right? So first, let's calculate the EBITDA. What did I say? It's 25,000, right? That's the EBITDA number that we have. Now, the chosen multiple, I'm gonna choose 5 times. Now, why? Let's go back up here and I'm gonna show you exactly why the 5, okay? Okay, so owner dependency, that's a negative. He's highly dependent on the owner. That means I gotta replace him and I gotta bring someone into that seat, which creates more churn on the back end sometimes. Geographic concentration, this is a huge plus. He's really concentrated close to the office, so huge plus, okay? Owner churn on a yearly basis is 25%. Now, depending on what I can do to bring in, I think I can get that down, but I'm gonna evaluate it off of this 25%. And then annual EBITDA, what's the net? But the door count is huge because it's allowing you to have a bigger team, which means if anything jumps ship, you still have a team. Okay, so let's go back to down here, the method 2, EBITDA. So I said 25,000 times 5, what's the evaluation? So you go 25,000 times 5. What does that equal? That equals 125,000, okay? Now you're all looking at this like no owner's gonna sell for that. No owner wants to sell for this. That's why cash flow is huge and you need to work on getting that up, okay? So this is, you can plug your own numbers into this. What's your EBITDA number and what you wanna sell for, okay? Think about it, you gotta bring that in. My revenue is huge, but if margins are weak, valuations drops, like I just said, as you can see. A PMC doing $2 million in revenue with a weak EBITDA may be worth less than a lean 800,000 company with a strong margin. Buyers buy efficiency, not chaos. And here's another mistake owners forget about. They forget about add backs. Maybe your company pays for personal vehicle, family payroll, owner discretionary spending, excessive salary. Pull those out of the P&L today. Make sure it's clean. These may be legitimate add backs that improve EBITDA. That matters because every extra $100,000 in EBITDA at a 6 times multiple is $600,000 in valuation. That's not small. That's life-changing. Now we're going to pause one more time. I want you to put your numbers in this evaluation where your company stands. What you think it's worth, how far your property is away from your office, different things that we just talked about, so you can see what you could sell your property on the EBITDA method. Now we're back. You ran the numbers on method 2. You know what your valuations are. But let's go over method 3, a multiple of revenue. This one's really common in the industry. Now let's talk about the method people love because it feels simple. Revenue multiplier. This one is common because This one is common because revenue is easy to verify. Less accounting debate, less EBITDA arguments. The standard range though that I see is usually in between 0.7 and 1.5 times annual revenue. Sometimes more and sometimes less, depending on quality. Now the formula, let's go through this. Like annual revenue on this one that I've already said. Let's go back up here. Remember, we have all this information on the PMC that we're actually analyzing right now. Okay, so here's all the information. The annual revenue, let's go back here, is $1,243,600. Okay, that's annual revenue. The multiplier I'm going to choose is 0.7. Now, why did I choose that? It's because their churn rate is high, the owners involved, multiple things. But they do have some positives. There's a bunch of properties right next to the office, so that's a great thing. So we put in 1.2 million, 400 and 600, and then we go 0.7. What's this equal to? It's $870,520. Okay, that's what this is evaluated on this multiple. This method works especially well when we find answers are messy, if it is unclear, or buyers want fast benchmark comparisons. But here's the danger. Revenue without retention means nothing. If owners are leaving after acquisition, the multiple drops fast. Recurring revenue matters, retention matters, predictability matters, because buyers don't buy last year. They're buying this year. So let's pause. Put your numbers in of your company, your property management company, or the company that you're evaluating. See what they're worth. But when you take this number, make sure you go back to the P&L that it can handle it. We're going to go on to method 4, so you can see that one, which is a big one. All right, we're back. You put your numbers in the third method. You ran your company's number or a company that you're analyzing. Okay, so now I want to go to actually one of my favorites. I love this method. It's a cash-on-cash return method. Let's talk about it. The method that serious investors love because it answers the question buyers care about most. Now, as a seller, you should love it as well. How fast, and this is the question, how fast does my money come back to me? An investor that looks at cash on cash, they want to know how fast their money comes back and if it's actually the best investment. We're not just buying doors, guys. We're buying an investment. This is cash on cash return method. And honestly, this is one of the most powerful ways to evaluate a PMC if the buyer is acquisition minded and focused on returns, not just ownership. Because some buyers aren't asking, how much is the business worth? They're asking, if I buy this business today, how long until I make my money back? That's a completely different mindset. And you, as the seller and buyer, should be looking at this. In a very small one, especially if the buyer is private, equity, an operator looking to scale, or an investor trying to compare multiple opportunities, this method forces discipline and removes emotion completely, and that's important. It turns the conversation into math, and buyers and sellers love math. What is cash on cash return? Cash on cash return measures annual cash flow received divided by total cash invested. It is simple terms. How much return am I getting on the cash I put into the business? Okay? It tells buyers, is this acquisition worth it? Or should I deploy my money somewhere else? Because every dollar has an option. If I'm going to get 2% here, but I can get 10% somewhere else, I'm going to put my money in the 10%. If I can get a better return elsewhere, that's what you got to do. Why buy the PMC if it's less? That's how sophisticated buyers think. So let's go through the formula. Let's really plug it in so you can plug your numbers in as well, okay? So here's the method, cash on cash. So we already talked about it in the other methods. If you need to go back, you can go back and look at it. I said on the other method we were going to buy it for $850,000, okay? Okay, total cash invested, it's going to be normally, historically, I can get about 10% if I go out and get debt. Okay, so if I do that, that's going to be $85,000 and $85,000 I'm going to put down, 10%, and the rest will be debt. Okay, so that's my $85,000 cash I'm going to put in. I'm going to put in so the bank gives me the money to give to the buyer so they can buy it. Okay, so annual cash flow after acquisition. We got the P&L. We already ran those numbers. That's $25,000. I'm not going to bank on bringing anything to the bottom line first year. Not really. You don't want to shift a lot. Otherwise, you churn owners and you churn team members. And that's the biggest thing you do not want to do when you're acquiring a PMC. So here's the numbers. Let's go through it. You go cash flow. How much cash flow? I have $25,000. Okay. $25,000 cash flow. Now, how much money am I putting into my own hard-earned money? It's $85,000. Okay? So, $25,000 divided by $85,000 gives you 29.4%. Okay? That's strong. That's a very strong cash-on-cash percent. Think about it. You invest in real estate, it's 10 to 12%, sometimes 6 right now. You do the market, it's 8 to 10%. Cash on cash, 29.4 is a really good cash on cash. Now, what you need to understand is you need to analyze it for the second year as well, because you're going to have a churn unless you can make sure that churn doesn't happen at 25%. Remember on the other method, we showed you that. So now compare that to another PNC offering 8%. Completely different deal, same industry, very different investment. This is why cash on cash matters. What is good cash on cash return? Okay, that depends on the buyer entirely. Some buyers want 10 to 12, others want 15 to 20%. But the question you have to ask is, where I deploy my money, where is it going to get the best return? So, especially the business carries risk, the higher churn, the higher owner dependency, poor system, the return requires goes up. Okay? Because risk demands reward. No investor says, wow, this looks risky. Let's pay full price. No, never happens. Risk lowers value. Strong returns increase confidence. That's why this method is so powerful. Why sellers should care. Now, and why buyers should care about it. Now, sellers sometimes ignore this method because they think that's the buyer's problem. Wrong. Because if buyers use this to justify their offering, or if sellers use it to justify their price, you should be able to understand it too. Both sides need to understand this method. If you know your business creates strong cash-on-cash returns, you can defend your asking price. If it doesn't, you know exactly what needs to improve. This helps you negotiate from strength instead of emotion that matters. Because buyers will absolutely run this analysis. Sellers will absolutely run this analysis. Even if they never tell you how to improve cash on cash. Let's talk about it. Want a strong return, increase cash flow, lower acquisition friction, improve transferability, raise maintenance profitability, reduce owner churn, bring on owners, strengthen lease renewals, income, improve operational efficiency, protect margins. Because every dollar of stable cash flow improves this model. And strong returns create aggressive buyers. Weak returns create low offers. Simple. Done. But here's one thing you need to understand. I don't actually take just one of these methods. I actually pull all of these methods together to give me a 360 halo view. I want to see everything. I want to have my eyes wide open when I go in and look at a property management company. And if you were selling it, you should be able to have your eyes wide open as well. So analyze on all 4 methods to get the true number the property management company should be worth. All right, now let's add it to our full evaluation. So now we have all methods. Price per door is where it comes out to be $833,000 to buy this PMC. EBITDA method, we're going to buy it for $125,000. Ooh, big difference. And then multiple of revenue, that values is $870,000. Okay? Now cash on cash return, that is valued at $850,000. Okay? Those are the valuations. So what we do, we bring them all together. Now the full picture becomes clear. Now just what the business is worth, not just what the business is worth, but what a buyer is willing to pay. And those are not always the same number. The difference is where deals are made or lost. Because a valuation is a theory, cash on cash is reality. And serious buyers live in reality. Now to sell for more, now let me tell you the secret. A valuation is created before the sell, not during it. You do not negotiate your way to a great exit. You prepare your way there. Want to have a higher multiple? Improve owner retention. Hey, this 15 to 25% churn rate, get it down below 10. Reduce owner dependency. Get out of the day-to-day. Rely on your team. Document systems. Keep strong financials. Build leadership beneath you. Strengthen maintenance revenue. Clean up reporting. Stabilize staffing. Make the business transferable. Because buyers pay more for certainty, not potential. Potential is seller language. Certainty is buyer language. That difference matters a lot. Final thought. When someone asks, what's my PMC worth? Okay, when you ask, what's my PMC worth? My answer is always, it depends. Let's find out. Not guess, not hope, find out. Because one method is a guess. 4 methods create clarity. Price per door gives speed. EBITDA gives truth. Revenue multiple gives market comparison. Cash on cash gives highest value of hard-earned money. Together they tell the full story. And whether you're buying or selling or simply preparing for the future, this framework changes everything. Because eventually, every owner will exit. That's reality. The only question is, will you do it strategically or emotionally? One creates wealth, the other creates regret. And I know which one I choose. I know most people want to choose. Thanks for coming along with me as we evaluate this PMC. Now plug in your own numbers and see what your business is worth today.